Hi, everyone, and thanks for joining us, excuse me, for Griffin Partners live webinar and Q&A session with CrowdStreet. My name is John Robertson. I'm Senior Investor Relations Manager here at CrowdStreet, and I'm pleased to have joining me this afternoon several members of Griffin Partners team who are going to discuss their most recent offering on the CrowdStreet marketplace called the Zachry building. After a brief presentation, we'll open it up for questions. Everyone's in a listen-only mode, so if you do have questions either throughout the presentation or during the Q&A portion of the call, please just type those questions into the questions box. We'll ask them on your behalf. I also wanted to highlight that we have, as is the case now, we've gone through the due diligence period and we have activated the Invest Now button on the offering page. So if you joined us just a few minutes ago and went to the offering page, just refresh your page and you will have access to the Invest Now button. And so with that brief intro, I'm going to pass it over to the Griffin team to kick things off.
Thanks, John. This is Andrew Montgomery, Executive Vice President overseeing acquisitions for Griffin Partners. We're excited to go through this webinar and talk a little bit about the investment at hand. First, I wanted to, through the posting content and the webinar information you have on your screen, wanted to give you a little bit of background on Griffin Partners. In the main paragraph at the top of that page, John, if you could scroll up, we are a full-service real estate operating company founded in 1980. We've been in the investment management business for a little almost 20 years, almost going on 21 years here shortly, next year. And we specifically target value-added investments, mostly in the office space and light industrial assets. Our overall performance kind of speaks for itself. I don't want to go into too much detail on our performance, but in particular in San Antonio, Griffin Partners, this would be our 6th investment in San Antonio since 2004. We've managed, owned, developed, redeveloped office assets only in San Antonio. It's a primary expertise for us in San Antonio, and we're excited that we're going to be reinvesting in San Antonio here by the end of the month in the Zachry building. If you want more information on our track record in detail, you can click on the track record tab. Our most recent sale, which was in San Antonio, and our 3rd fund, was the tallest building in downtown San Antonio called Bank of America Plaza. We have been investing in that market since, correct me, not since 04, but December of 03, in various assets in the market, in particular in the Northwest as well. Edward, did you want to add anything to that in terms of our performance?
Sure. At the page you're looking at, this is Edward Griffin. I'm the president and CEO of Griffin Partners. I've been active with the firm, not since its founding in 1980. That was my father who founded the firm. I joined in 2001 after a career in banking and investment banking. And as Andrew mentioned, this will be our 6th investment in San Antonio. Our 5 previous investments were all successful. You can see several of those at the bottom of this page here. For example, the Northwest Center, Colonnade 1, and Union Square 1 and 2 were 4 of the previously 5 owned office buildings we had in San Antonio. We acquired those, as Andrew mentioned, very late in the year in 2003. Actually, that's why I consider them to be 2004 acquisitions. You can see out to the right, they all performed pretty well at 18, 15, and 13 rounding for levered returns and multiples averaging just slightly under 2 times. And actually, in one of those, we actually owned it. We ended up owning it a little longer than we thought. Northwest Center was the last of those 4 for us to sell, but it still performed well from a multiple perspective at almost 1.9. When you own something for 9 years, your IRR, if you still get a 12.6 IRR, that's actually probably a pretty good return on a 9-year hold. If you scroll down a little bit, John, you can see our most recent round trip in San Antonio. It might be 2. You might have to back out of that one and open the second one, John. There you go, right that one right there. So you can see there's a San Antonio asset there, Bank of America Plaza. Andrew mentioned that briefly. It is the second tallest building in San Antonio, a little over 500,000 square feet. We purchased that in December of 14 and sold it in August of 17. It was really a core plus investment with very low leverage. We had less than 50% leverage on it. As you can see, there's not a big gap between the unlevered and the levered return. We sold it early. We had an offer that we thought was an appropriate offer, and we sold it to USAA, even short of a 3-year hold, and was a successful investment for us as well. If you back out of that, John, and click on case studies, I believe there's a couple of pictures in there we can show that were San Antonio office buildings as well, just to give you a sense of it. That one, this Northwest Center that I mentioned right there, was the one that we ended up holding a little bit longer than we initially anticipated. We held it until mid-2013. And suburban office, similar, a little bit bigger building, obviously, but similar profile from its suburban nature. We close that and scroll down. I believe there's one more. I believe the Bank of America Tower's in there too, John. There's Union Square 1 and 2. We actually built Union Square 2, so we have some experience. So scroll back up for a second, John. Right, click right there. You see at the bottom of the page, Union Square 1 is on the right. When we acquired it in December of 13, there was no Union Square 2 building on the left. It was a vacant tract of land, which we developed ground up. So we have experience leasing a building back from completely, or not back, but leasing a completely vacant building in suburban San Antonio. Then if you back out of that and scroll down just quickly, you can click on Bank of America Plaza right there. That is the downtown tower that we own and sold to USAA. I'm going to turn it back over to Andrew.
So, thank you, Edward. That summarizes our overall experiences in San Antonio and our track record in San Antonio specifically. I wanted to move over to the investment at hand, and I'll start really with the location, which you can scroll up, John. The location attributes, why we like this submarket area, in particular the far northwest submarket. As I mentioned, the location is in Northwest. It is on the Highway 1604, which is a major thoroughfare between I-10 and Highway 281. This particular area has seen a huge amount of population growth over the last 10 to 15 years. It's experienced one of the largest growth patterns in millennial growth, over 15% since 2010. It's the third fastest growing U.S. economy over the last 5 years, trailing only Austin and San Jose. So this particular micro market of San Antonio has seen a tremendous amount of demographic growth northwest, just in the crosshairs of this particular building. In particular, because of that growth, the overall office development over the last 10 years has grown by almost tenfold. One Class A asset was in 2005 in this part of the submarket. Since that time, over 2 million square feet of office product has been delivered since 2005, totaling approximately 15 office buildings. And in that same period of time, the average occupancy of all of those buildings has averaged at or above 85%. And the reason for that is, in our opinions, is the overall strong demographic demand and growth of the submarket. Also, because of the corporate relocations in this area, in particular USAA, New Star Energy, who used to be a tenant in this particular building, have built large campuses in the area within 5-minute drive to access the neighborhoods, retail, multi-tenant areas of the Northwest submarket. So we feel very strongly that this particular location over the next 5 years will continue to improve because of its previous track record in high occupancy and high intrinsic demand for this area. To note, besides the office product, this location over the last 10 years has seen over 25 new multifamily projects totaling almost 5,000 units in the area. There are currently 6 new multifamily projects under construction today. Further, there are over 43 retail centers that have been constructed over the last 5 years, totaling 2.5 million square feet of new retail along 1604. And for that, we feel strongly that over the next 5 years, this market will continue to see strong demand from the demographic areas in the surrounding area. Kind of stepping away from the location a little bit, I wanted to talk about the property itself. Scrolling up, John. Just talking a little bit about the actual bricks and sticks of the building. This is a 82,000 square foot building, 3 stories. It's a tilt wall construction with dual pane glass. It's got 9.5 to 10 foot ceilings, depending on the floor. The first floor is 10 foot ceiling heights, which is an above standard, in our opinions, in the market. So it's truly a Class A project. It has a little under 4 per thousand parking surface spaces. It's within the Heritage Oaks Office Park that was developed by a very quality developer called R.L. Worth, who's got a strong track record of good product type in this San Antonio market. And the overall floor plate design, which you want to click on the floor plates, it's a rectangular floor plate, which we like a lot for both single tenant and or multi-tenant use, because the center core design, or where the elevators sit in the middle of the rectangle, if you will, allows flexibility to lease in full floor increments or break the space up into multi-tenant spaces. Currently, the configuration, of course, is a single tenant, with Zachry Corporation leasing the entire project. So moving on from just the property specifics, talk a little bit about the tenant. You can click on that same page. The tenant is the Zachry Construction Corporation. This is a family-owned business that was created in San Antonio in the early 1920s. Zachry Corporation, this is their corporate headquarters nationwide. They purchased a building in 2013 from the developer, which is R.L. Worth, who I mentioned. And prior to that, when it was developed in 2007, it was fully occupied and leased by New Star Energy. So the building itself has never been unoccupied and has always stayed 100% leased. Zachry Corporation has signed a lease with us to lease the building back at 21 net, triple net, where they're paying all operating expenses and paying us $21 net in rent for the next 3 years. The reason it's 3-year lease term, they have been recently assigned a new mixed-use development in downtown San Antonio that includes office, retail, residential, hotel, and some residential / multifamily. And they're going to take the office component. That project is kicking off here momentarily, and hence they're going to leave the project at the end of the 3-year term. Zachry's construction balance sheet is extremely strong. I would say it's investment grade, even though it's not. It's privately held. They have a very large cash position, so we feel very good about the viability and the payment of rents over the next 3 years with their construction company standing behind the lease. So moving on, just kind of the overall business plan, if you want to scroll up. As I mentioned, the investment here is obviously we're going to provide us a stable cash yield over the next 3 years. And as a part of that impending vacancy, we feel strongly that we can market the building over the next 3 years because of our track record and our relationships in San Antonio being our 6th investment. We have a fair amount of time to position the building in the marketplace for either single tenant or multi-tenant use upon their vacating scenario in 2021. Again, the location, which we talked about, we feel strongly that this area, because of the corporate migration and overall demographics, will be able to release the project. During the due diligence process, we reaffirm the building square footages for either a single tenant or multi-tenant use, and feel very good about the layout and design of the building to release the project. To talk a little bit about our releasing effort and our assumptions, Upon their vacate scenario in 2021, we would release the project by mid-year 2023, so take us about 18 months to release the project. We think we'll be able to outperform that, considering the historical occupancy of the building, much less the historical occupancy of its competitive set, approaching between 85 and 90% on average. The downtime between leasing spaces in that submarket varies between 3 and 9 months. We obviously underwrote an 18-month plus or minus lease-up period, and feel good that we will be able to achieve that as a part of our underwriting in this investment. Moving on to just the financials on the investment page. If you wanted to click on the financials themselves, we have executed agreement with East West Bank to provide financing, fixed rate financing over the 5-year period of our ownership. They will provide us monies to pay for tenant improvements, leasing commissions, and capital to restabilize the project.
John, click on project level if you would, please. To the right, to the right. Oh, that, well, actually where you were, summary, financials, I'm sorry, financials. And then down the lower tabs, project level, there you go.
And so the overall project level returns with our equity and our lender in tow is approximately 16% or exactly 15.7% IRR to CrowdStreet investors, and just under a 2x multiple of 1.9, and an average cash return of the first 3 years of a little over 9.5%. And due to the releasing effort in year 4 and restabilization in year 5, the average cash on cash is roughly 6.3% based on our underwriting as of today.
So let me jump in there for a second. We've already had some questions from folks who have reviewed the opportunity on the site and have asked about the year 4 cash flow of 0. First, before explaining that, let me back up and talk briefly about the 9.3 and 9.6% yield in years 1 through 3. That actually is not all of the cash flow. We are setting aside some reserves from the positive cash flow from the property during the 3-year lease term with Zachry into a reserve account, just under $500,000 a year, so that when we reach year 4, the property and the partnership, actually it's not a partnership, the property and the company that owns the property will control about $1.5 million in cash reserves, and then in addition, our lender is providing $3.9 million in good news money to also be spent on re-tenanting the building. So we're paying the 9% on top of, and in addition to setting aside those cash reserves over the first 3 years. And then it does go to 0 because, as Andrew mentioned, we expect that it's going to take approximately 18 months to fully re-tenant the property. It's certainly possible we can outperform that. Our goal, of course, is to be marketing the property during the entire time of the 3-year initial lease. And sometimes we can be fortunate and actually have tenants ready to go at the time that Zachry moves out. But we've underwritten it, we think, reasonably conservatively, that they actually wouldn't have anybody ready to go when the tenant moves out, and then it takes us 18 months to fully release the building. During that time, obviously there's debt service to pay and there's operating expenses to pay. And so that's why we have those reserves set aside. And then when the building's re-tenanted, you can see about halfway through the year 5, it's been fully re-tenanted, so we can resume cash payments, although we would expect to exit sometime near the end of the 5th year. Our expectations on re-tenanting it are that we probably will have a multi-tenant asset, perhaps 1 tenant per floor, or maybe 1 floor that's got 2 tenants. But of course, we're not going to rule out any opportunity to lease the entire building to a credit-worthy tenant.
And so lastly on that, this is Andrew, and if you want to scroll to the top, the key deal points, in our opinions, are obviously the location attributes and the overall submarket drivers that support overall demand for office space in this particular node in San Antonio. I didn't touch upon the access, but we think the access just off 1604 and Bitters Road is at a 4-lane interchange moving east-west on 1604 is very accessible and a strong attribute to the access of the project. The corporate migration, which I touched upon earlier, with very large name brand companies with USAA, Valero, InCap, Newstar, who was previously in this building, to name a few, are within a 5-minute area of this particular project. Obviously, the historical performance of the building being 100% leased, we'd like to continue that trend. Also, signing a lease with a very viable credit entity with Zachry Corporation, construction company, a family-grown and built business in San Antonio, and that's about all in terms of the key deal points. We wanted to open it up for questions or any discussion topics on the the carried interest or non-sponsored carried interest.
I'll talk briefly about that. The deal structure is very straightforward, simple deal structure. There is no preferred return or carried interest. All distributions will be made pari passu based on an investor's percentage interest. The only reason we've had a couple of questions of why are there two classes of stock then, and the reason is that our fund will hold the Class A stock, and the other investors will hold Class B. And the Class B will actually pay a 1% per annum asset management fee. That's 1% paid quarterly, 1% per annum paid quarterly, so 1/4% every quarter on the amount of invested equity. And that's really just to create parity with our fund investors, because our fund investors are carrying a 1.25% asset management fee based on their invested equity inside the fund. And so in order to have the fund investors and the non-fund investors be on relatively equal footing, that's the reason for the bifurcation in the classes of stock. Griffin Partners does self-manage everything that we own, so we will be the property manager for this property. So there's a property management contract and a property management fee. It's equal to approximately 3% of the gross revenue of the property, which in San Antonio for a property this size is a market-based fee, and we're comfortable as that's an arm's length amount. We will not be the leasing agent for the property. We will hire. Griffin Partners is not in the brokerage business. We will hire a local brokerage firm to represent us for this property. We have experience based on our previous ownership in San Antonio with all of the local brokerage firms, of which there are several that are excellent, and I'm sure will do a great job for us.
That's all we had today, John, for a summary. And if we have any questions or any further comment, we're happy to provide.
Okay, great. Thank you. And just a reminder to the audience, if you joined us late, please just type your questions into the questions box, and I'll ask them on your behalf. We already have a few in the queue right now, so let's get things started. The first question is, obviously the fund, as you mentioned earlier, is taking the Class A shares. Does Griffin Partners as an entity have invested capital into that fund? And I guess kind of as a follow-up to that then, and if so, and if not, then what would be your actual skin in the game or co-investment into this particular asset?
Yes. So yes to all of the above. So Griffin Partners, myself and our partners individually have approximately 24% of the fund dollars. So of the $3.4 million that is being invested by the fund, about $1 million worth of that is a little under $1 million is actually people from the hallway, sitting down the hallway from me, or sitting in this room at the moment. Good question.
Okay, great. And then you mentioned obviously that this is a pari passu investment, so there is really no hurdles or true waterfall breakdown. But I guess the question is, what's the sponsor investor split after the cash flow distribution? And I think just to clarify, it is just truly a pari passu split.
That's correct.
Your pro rata share.
Correct. So looking at the page that you're looking at right now, you can kind of interpolate from that. So essentially assuming that the CrowdStreet investor equity is fully subscribed at $3,350,000. It's about a 51-49 deal, and the cash flow splits will be 51-49.
Got it. Okay, next question is, what are the returns to investors during the period when the building is vacated and then released? We obviously have that information up here on the financials tab. So obviously in year 4, we see the exit here. And then as you re-tenant, potentially kicking out a little bit of cash in middle of year 5. Well, I don't want to steal your words, so feel free to further clarify if I missed that.
No, that's exactly correct. So we should have 3 full years, 36 months exactly, of just under 10% distribution. So at that point in time, you should have 27 to 30% of your money returned to you. Year 4, we are currently not projecting in our base case projection any distributions to the ownership during year 4. We project that those distributions resume in year 5, probably in the 19th or 20th month. And they will probably resume at a number similar to that kind of 8 or 9% return from a cash flow distribution standpoint, from cash from operations. The reason it only shows 2.8 in year 5 is because we're not starting that cash flow stream back up probably until September or October. Again, based on our base case. We could outperform that. We could, it could take longer to lease it back up. Essentially, you have to get the building back to about 65% leased before your cash flow turns positive again. So if you think of the building, as I said earlier, the releasing, if it is 3 tenants, 1 on each floor, once we get 2 of the 3 floors leased, effectively 2/3 of the building, we should be able to restart distributions. Although at 2/3, it probably won't be running at a 9 or 10% year per annum rate. It probably half of that. Once it's completely restabilized, it should be back to kind of 9 or 10%. But of course, at that point, we'll be looking to exit.
Okay, great. So next question is around cap rates. Looks like you're acquiring at 10%. Is that kind of within the market norm right now for 100% occupied asset in San Antonio? I guess the question is, that seems like a relatively high going in cap rate. So kudos to you for being able to identify those deals. But then the exit cap rate is significantly compressed. Can you talk about the rationale between the going in and exit cap rate assumptions, particularly in light of a potential rising interest rate environment?
Sure, happy to answer that. This is Andrew Montgomery. The 10% cap rate is obviously, cap rates are a judgment of risk. And the higher the cap rate, the higher the risk per se. The lower the cap rate, the lower the risk. Like if you're buying a bond, it's 3 or 4%. If you're buying this particular asset, which is only a 3-year lease with a credit entity, we're paying a 10% cap rate for that risk, knowing that the tenant will not be there in 3 years. If we look at historical average cap rates in San Antonio, which we can scroll to on the sales comps, the average cap rate for multi-tenant office buildings in San Antonio is roughly a 7% cap rate. An average price per square foot, most recently under contract, is at $285 a foot at a 7 cap. So average cap rates today for multi.
Scroll down, John. Keep going. Sorry.
Yeah, multi-tenant office buildings is around a 7. For single-tenant
keep going
buildings in San Antonio,
keep going.
The average cap rate is approximately a 6.5 cap rate for single-tenant office buildings.
Keep going.
That's with
right there. Sales comps.
That is with tenants that are user buildings that have leases in place that are at a minimum 5 years. I don't know why we can't see that much larger, but that particular table right there summarizes price per square foot and average cap rates today for multi-tenant and single-tenant buildings. And that, if you're looking at a risk continuum during a rising rate environment. If we look at average cap rate based on our data, the average cap rate for multi-tenant office buildings over the last 12 years in San Antonio is roughly 7.3 to 7.4%, which is our exit cap rate in this particular underwriting. And the reason we use that rate is because it was an average. We think we'll outperform it, but again, we took the average.
Okay, that makes sense. And yeah, apologies for the small sales comp gap, John. I would just encourage any investor who wants to drill into this just to go to the offering detail page and just to go to the sales comp, and it should be big enough to see on your monitor. Let's see. Next question is, considering the location attributes, does Griffin believe that this will continue to be a strong location to attract any single, one tenant user? And I guess as a follow-up, if not a single user, obviously you're going to see demand for multi-tenant. So maybe just talk a little bit about that.
Sure. Well, considering the project's history, it was, when the building was delivered in late 2007, it was leased to NewStar Energy, 100% to one tenant. So the building is obviously performed as a single tenant building. When NewStar vacated, Bob Worth, the owner at the time, the developer, turned around and had a pre-sale when NewStar left and sold the building to Zachry for another single tenant use. I would say there's more than 6 to 10 users in this particular submarket that would look at this building as a user building. We would obviously want to discuss that opportunity and releasing effort over the next 3 years for their growth needs. Tenants ranging from 20,000 to 40,000 square feet that would want to take this size or 3-story, 80,000 square foot building. So we think it's a very good opportunity for another third user to come in and release the building. Although our underwriting, we've been conservative and we've assumed that we will multi-tenant with TI allowances, commissions, et cetera, over in full floor increments to release the project.
Okay, thanks. So besides re-tenanting in years 4 and 5, what other risks do you kind of anticipate or kind of see as being on the table for this deal?
Well, one could say that the physical product, and we've spent a lot of time. We pride ourselves in buying real estate that's Class A, well-designed, well-developed product, and I would say this checks all the boxes for us in terms of its quality, design, and construction. Considering a construction company is leasing the entire or owns the entire building, they have kept very well care of the building. It has redundant power with 2 generators. It has very much allowable parking ratio. The floor plate design is 28,000 square feet, which is very nice for a full floor user, single tenant user, as well as multi-tenant. We did a property condition assessment and found no issues. There were some various deferred maintenance in terms of landscaping and common area upgrades and things of that nature, but the physical attributes of the operations of the project are very well maintained, and that was one risk we wanted to make sure was taken off the table as a part of this investment.
There's also, I would say, there's a little bit of risk. The submarket may become a victim of its own success. Frankly, there can be some congestion on the 1604 freeway in that segment between the 2 north-south highways, and it's a function of the amount of growth and the amount of density that has occurred in the area in terms of new investments and the submarket becoming more infill in nature. So that can go too far sometimes, and locations can lose some of their appeal because of congestion. San Antonio, frankly, has done a pretty good job with its infrastructure, and as well as Bexar County and the surrounding counties. And 1604 is not an interstate; it's a state highway, so it has been dramatically improved, frankly, in the last 7 or 8 years. But even with those improvements, the congestion can be a bit of an issue during rush hour. So certainly there's always a risk, but if you look at the way this submarket has performed, as we've indicated, I'm not sure where it is in this material, but we have graphs that show the average occupancy and the growth in rental rate. And the growth in rental rate in particular is a graph, in this case, it's a graph that we don't often see. Usually you see volatility in that rental rate growth line, and this one, for this submarket in the comp set, for this building, it's practically straight up not straight up, but it's up and to the right, practically in a straight line. So obviously and it goes back, I think we go back 14 or 15 years in that assessment. So the submarket has seen a lot of growth, seen highway improvements, congestion, and relief over that time period, and still continue to outperform. So we don't think that's a big risk, but it certainly could be a risk.
Well, and on the flip side, one of the markets that has not done well over the last 7 to 8 years is south of 1604 on I-10 because of this strong congestion downtown. A lot of executive neighborhoods have moved into this location over the last 7 to 8 years and migrated north in this particular area. So it's kind of, as Edward said, a victim of its own success because of traffic southbound further south. So we see, the demographics not changing, if anything, improving. But being on this interchange of Bidders and 1604 is a very strong attribute for future access as well.
Lastly, I might add, just as a macro market perspective, as a risk, San Antonio is very much heavily influenced by the amount of the overall military budget spending. There used to be 4, there's still 3 active military bases. It's actually benefited from the base realignment program that started over a decade ago by virtue of operations being consolidated into San Antonio. But it's certainly possible if there was a major shift in the military budget, just in terms of overall spending, that could have a negative impact on the San Antonio economy. There's no military uses in and around this submarket. It's all business services and professional services and construction companies, oil and gas companies, that kind of thing. But the market as a whole certainly could be impacted if there was a major shift in that.
Okay, fair enough. Thanks for that thorough answer. Let's see. Next question is, will there be a cost segregation study done on this subject property?
Yes, we always do cost segregation studies in order to maximize the tax benefits for all of our investors.
Okay. And then next question is, what ongoing reporting will investors receive in terms of financial updates and annual tax returns?
So we report and publish reports to the investor portal monthly on all our investments like this. Our fund reports quarterly, but on all of these individual properties where we have investors participating alongside our fund, we produce and publish monthly reports. They're very thorough reports. They have full financial statements, updated rent roll, commentary about things going on at the building. Obviously, the rent roll the first 3 years is not going to change very much. There's not going to be a whole lot of comments on the building, but it'll have marketing once the tenant moves out, or actually hopefully before. It'll have a leasing report. It'll have marketing comments from our leasing agent. It'll have full financial statements, profit and loss, balance sheet, cash flow statement. And then annually, we produce a year-end financial statement, and we produce that's a little bit more detailed and has audit adjustments in it. The statement itself for the building for the year might not be audited, but it's effectively audited because our fund is audited, and the auditors have to do a fair amount of procedures on the books of the individual properties below the fund in order to be able to produce an opinion on the audit of the fund. So in effect, the year-end statement is audited, and it's got audit adjustments in it. And then we provide K1s to all of the ownership by March 15th of each year.
That's fantastic. All right, good to hear. A follow-up to the cost segregation study question, investor, maybe, I don't know if you have this data in front of you, but the question is, how much of the investor return would be tax sheltered?
Our experience in an asset like this is that for the first few years, the taxable portion of income will be relatively low because we will be able to front load, because of the cost segregation report, a fair amount of the improvements. And in this building in particular, there aren't a whole lot of interior pictures, but having been in it now several times, I can tell you that the Zachry has substantially over improved the interiors of this building. So our smart cost seg team consultants, they're outside guys, will certainly be able to use that to all of our benefit and load a fair amount of the purchase price of the building into relatively short-term depreciation categories. So I would be surprised, quite frankly, if there is actually even positive income during the first several years of our ownership. And in fact, since the fourth year will be a year where we don't have a lot of income, or income's reduced, it could be that there's not a whole lot of positive taxable income in this thing until we sell it in year 5.
Okay, great. All right, that concludes the amount of questions that I have right now in the queue. Let's just talk about a couple of kind of key dates and updates. I have the offering detail page pulled up here, and let's just walk through some of these items on the right-hand side. Obviously, there's a short fuse here in terms of your closing date and when you'd like offers and then funds due. So let's just talk about the timeline here.
Sure. We're currently scheduled to close on the 20th, which is next Tuesday, a week from today. So we are hoping to have offers in this Friday the 16th, and funds in on what's been the weekend, going through those offers and hopefully accepting all of them, and then funds due on Monday the 19th. And that's our current timeline. It certainly won't get any shorter than that. It's possible that we may have the opportunity to extend the offering and close with some other resources and then let some folks backfill. Obviously not our, we'd like to try to get it all buttoned up and move on down the road as quickly as possible, but we'll have to see how things go.
Okay, and lastly, just to kind of, in conclusion, if you have another question that we maybe didn't address on today's webinar, but you'd like to send it to the partners here on the call today, please just type your question into this questions box here and send it to both the sponsor and CrowdStreet. If the question's better suited for CrowdStreet to answer, we'll of course chime in right away, and we'll allow Griffin, up to a business day to respond. And gentlemen, I want to thank you for your time today, and thank the audience for your participation and questions. And just to let everyone know, in case you joined us late, the Invest Now button has been activated on the detail page now that we've ran the webinar, and we are starting to accept offers. So I'll pass it back to you guys for any closing comments.
We appreciate everybody who has spent time with us on the webinar today. Thank you for your time, and thank you for your interest. Just as a reminder, this is our third offering through CrowdStreet, and we are pleased to be partnered with CrowdStreet in providing these opportunities, and we're grateful for those of you who are interested in participating.
Thanks, everyone. Have a good afternoon. Bye.
Likewise.
Now we wait. 30 people